Hello, clients and friends of MBP Sterling Partners. It's Jamie. I am back with a recap of 2024. I'm going to try to keep this one really quick because I'm sure you've read a lot of recaps and learned what's happened in the market already. But let's go over it quickly and hopefully we'll set ourselves up for the 2025 outlook, which will be the next click in the list of videos to watch. The themes that we were looking at for 2024, well, obviously political change. We saw some south of the border, and we are expecting some. I think we saw the beginnings of it on our side of the border here as well, and we expect to see a lot more of it in 2025. But it weighed heavily into market returns. We all know that November in the equity market was a pretty great return month. Happens to coincide with the election results. We'll just leave it at that. But it did weigh heavily into what happened in the markets. Index concentration is another theme that we've been talking about for a very long time, long enough that I'm starting to get bored of it, but it is important and it continued throughout 2024. In fact, the index concentration, as we'll talk about a little later in 2024, started to hit some new highs. So this was US versus the world, large cap versus small cap, growth versus value. It's all the same trade and it's all the same trend. And lastly, the arguably most important theme for Canadians for 2024 was the decline in the loonie. We're not going to picture it or frame it as a negative thing necessarily. A decline in the loonie has a lot of positive externalities. So we'll talk about how we got here and potentially what we should expect going forward, but we'll leave most of that for the 2025 outlook. So firstly, let's look at the broad market and indexes. This one is really quick. We all know what happened in the equity markets. It was almost a universal sweep higher. Equities looked really good all around. There was a small outlier with real estate equities. Real estate is firmly in its bear market right now. It didn't get any help from interest rates declining throughout the year, so it was the only sector that lost ground. Similarly, the bond market, which had been doing quite well earlier in the year, gave up a lot of ground in the fourth quarter. And in the US market in particular, gave up almost its entire year's return. So even though we've got green on the screen for bonds, it is considerably less than at the Q3 talk that we talked about 3 months ago. Interestingly, the source of those returns is important as well. This chart on the right shows where the returns came from in the equity markets. The blue bars at the bottom are multiple expansion. So when a stock goes from trading at 15 times forward earnings to 16 times, its price goes up, all else equal. Well, multiple expansion accounted for about half the returns in the US and in China and in the rest of the world. There are areas where there was very little multiple expansion, emerging markets, and in Asia as well. The gold bars here show earnings growth, so that shows a healthy growth in the market. So even though it was a really big up year that nobody was expecting, it was earnings growth that drove at least half of this. We'll find that these things tend to be coincidental. People tend to want to pay more for earnings as they're growing, and earnings multiples contract when earnings are flat or shrinking. So it's quite common to see these two things rise at the same time. But we like to point out that this is a healthy bull market when earnings are growing. Ultimately, stocks are fundamental earnings machines, and it's their growth in earnings that drives their growth in share price, not the other way around. So over the long term, we like to see those gold bars grow and grow, and that's a sign of a healthy bull market. We promise this is the last time we'll use this chart. We know we've used it a lot. This shows the cap weighted versus equal weighted S&P 500, meaning the cap weighted is heavily weighted towards those big magnificent seven. Now you might want to call them magnificent eight stocks, including Broadcom, which is now through $1 trillion. But when you look at cap weighted, the concentration is huge. And again, whether you're looking at the capitalization, so the concentration into these big names, if you're looking at it as growth versus value, or if you're looking at it as US versus rest of world, this is really all the same trade. And we saw this spread reach new highs. So 2024, a whopping 12% difference between the S&P cap weighted and the S&P equal weighted. So this trend continued in 2024. We can see it started to fade out just in the end of December there. So we'll see if 2025 is the year where this trend reverses. But last year it was firmly in place. In the interest rate world, the bond markets were range bound, really. We saw some rallying in interest rates through Q3, meaning declines in interest rates, rises in bond prices. That led to some decent gains, but a lot of those were given back in Q4, particularly in the US. On this chart, we like to highlight the divergence in the US rates in blue and the Canadian rates in red. You can see them moving higher. They were already higher than Canadian rates, but they're spreading out even further towards the end of the year, where the benchmark 5 and 10 year rates were approaching 5% in the US, where we're stuck down near 3% in Canada. This differential is causing a lot of the Canadian dollar decline. So obviously, just in simplest terms, if you can earn 4% in a US dollar and 2.5% in a Canadian dollar, you're going to favor that US dollar. So that's caused a lot of loonie decline. The reasons why rate differentials are growing so much, we'll talk a little bit more in the outlook. It has to do with Canadian household indebtedness. We are far more indebted than our American neighbors on a house by house basis, and it is weighing on our interest rates, which causes this currency to decline. But make no mistake, Q4 really was a tale of both sides of that trade. The US dollar started to take off in and around September. It was really strong through the last quarter of the year, and a lot of that strength led to what we see as Canadian dollar decline. It was both. Canadian dollar was declining and the US dollar was rising, but it exacerbates and makes that chart of the loonie look particularly bad through Q4. Last year, what did the strategists say? Well, at the start of the year, in 20 strategists on Wall Street that were surveyed, collectively they averaged to guess for a 1% return in the S&P 500. So at the start of the year, the S&P was at about 4830, and they were predicting a 1% return on average. Pretty wild. 6 of the 20 strategists were predicting a decline in the index. And you'll recall back at the end of 23 and the beginning of 24, all the talk was on when the recession would start. We had just finished a bad bear market through Q4 2022, and everyone was expecting us to dip into recession and have another negative year for stocks, or at very least a flat year. This is important to point out that, and we'll talk about this in the outlook as well, the strategists are generally wrong. And boy, were they wrong this year. We actually turned in a 25% return, 5882 on the S&P 500. It was north of 6,000 at one point in November. So it really points out that Wall Street in general was overly bearish. They missed the target, and they generally do. So in the outlook, we'll have a look at what they're saying for 2025. Again, we'll look at it just to get a beat on sentiment as opposed to understanding where they actually think it's going. And it was clear that the sentiment was negative at the start of 2024. That's all we've got for today. Please join us for our 2025 outlook, which will be posted shortly, and you'll get a link to it in your email inbox. Have a great day, everybody.